What stocks are going to perform the best in the long run? Guys, I want you to hear me on one thing. We're not talking about day trading. Mo, you love to trade based on charts. Mm-hmm. That's not what we're talking about here. Why? Because when Mo trades on charts and I trade on charts, we could not care less what stock we have. It's all just numbers to us. By the way, side note, when you're saying how little you care, a lot of people will say, I could care less. When you say that, you're showing, I could care less than this. The proper phrase is, I could not care less. Okay, back at it. So what matters though in the long run, what stocks will perform best in the long run? Very simply, value stocks. Mo, what is the definition to you of value investing?
Trying to buy a company, or actually forget a company, trying to buy $1 for less than $1, and for that reason, but buying a good company with good financials that is actually going to be worth more than $1.
Yeah. So what is the hard part about value investing? Like, what's really the hard part in it?
Buying and waiting and being very patient and finding good stocks.
Yes, because guess what? The future is unknown.
Yeah.
We don't know the future. So let me break this down before we get into individual stocks, and let me explain this. Let's say I gave the opportunity to buy an investment, and the projected returns for the investment for the following 5 years were as such: $2, $4, $6, $4, and $4. What's the total here? $6, $12, $20. Okay, so I'm telling you, buy this investment. It's going to give you $20 of cash flow over the next 5 years, and then it's going to go away. So that's your only potential. What are you willing to pay for this investment? Well, very simply, if you pay $20, what are you going to make?
You get nothing.
Zero.
You pay $20. That's $20 out of your pocket. And over the next 5 years, you get $20 back. It's zero. Okay. What about if you paid $1? Is that good?
That's really good.
That's really good. Why? You're paying $1 today, and you can get $20 in the next 5 years. You're going to net $19 on your $1 investment. Okay. What if you pay $40?
Really bad.
That's really bad. You're going to lose $20 because you paid $40 today. Now, this is what value investing is all about. Value investing is about sitting there saying, we don't know the future, but we can project what's going to happen in the future based on understanding the company, understanding the fundamentals, and there's obviously more to the company than just cash flow. There's also the balance sheet, but there's also, most companies have a lifetime of much longer than 5 years. Mm-hmm. So our goal is to spend less on it. Why? The less you pay for the company, you're going to make more return paying $1 versus paying $2 versus paying $3, etc. And somewhere along the way, there's a dollar amount that makes it worth it to you based on what your return requirements are. Yep. When you're buying a stock, you should have a higher return requirement than investing in U.S. government treasuries. Why? Treasuries, all you're doing is getting a check, and that's it. There's no upside potential. With a stock, the theory is, as the company goes on and on and on and makes more and more money, the company's worth more money, right? So this is the hard part about value investing. And by the way, Mo, what does Warren Buffett say about the term value investing?
Oh, everybody's a value investor.
Well, it's redundant. Yeah. Warren Buffett says the term value investing is redundant because the proper investing is giving yourself ample margin of safety so that you could be wrong, because margin of safety is the key element of value investing. Yeah. We're going to be wrong on things. We don't know the future. We have no idea.
A lot of the time.
What was that?
You're going to be wrong a lot of the time.
Absolutely. Like, what does Monish Purvai say? He says like 50% of the time you're going to be wrong.
I mean, there's people that say 60%, but you're mitigating your risk on those investments that you...
The larger margin of safety.
Exactly.
So what you'll find in value investors like myself doing is saying, hey, I think the company is worth $200 a share through my analysis, okay? If I pay $120, I have 40% margin of safety, $80 on the 200. If I pay $180, I have 10% margin of safety. Well, if I have 100 companies with 40% margin of safety,
probably going to do pretty well.
Probably going to do a lot better than if I have 20 companies with 10% margin of safety.
Right.
Right? Yep. That's all it is. You're just betting. You're an educated bettor. That's it. That's all you're doing in investing. You want to find great companies at great prices. And I actually don't, Warren Buffett's phrase of, it's better to buy a great company at a fair price than a fair company at a great price. He's right. But everybody thinks fair price means no margin of safety. I do believe it's possible to buy great companies at great prices. Because even though the margin of safety might not be as high, but to be able to get an Apple or Microsoft at 30% below what you think it's worth.
That's when the psychology of it comes in, though, and the emotion.
Explain that further.
Our perceived price on Apple is, let's call it 130 for the argument's sake.
Okay.
At 130, I'm not going to buy Apple. I'm going to say, hey, I'm going to wait for this to get to 100 or 90. Now, for me to think Apple's going to get to 100 or 90 is kind of crazy to a lot of people.
Yep.
It's not going to happen to a lot of people. But you have to be patient. You have to.
And guess what? What if it doesn't happen, Mo?
Well, if it doesn't happen, it doesn't happen. I move on to the next stop.
Exactly.
Yeah.
Everybody in this world thinks that when you find a company, you have to be willing to buy it. No. That's why we have our software. That's why we have look at my watch list here. I have 99 companies on my watch list. 99. You know why? I only want to own 15 or 20 of them, but I realize that most of them probably won't go to the price I want them to go to in the ample time. So I'm hoping that 15 or 20% of them do. And as time goes on, I add more companies to this watch list at lower prices. And that's the key. You should be okay saying no, because a good investor, a good value investor, is able to say no and be patient. Just wait for the company. And guess what? In the time it takes Apple to fall from 130 to 100, maybe it falls to 110, but the fundamentals get so much better.
That's exactly that they meet up with the stock price.
Yes.
There's always the possibility that the company can fall and the fundamentals can get better and they meet in the middle.
And I want everybody to remember, essentially the stock market is a conglomerate of all the companies. So what I like to do is I like to look at the S&P as one very, very large company. So if you're new to our channel and this is making a lot of sense to you, subscribe. If you're one of our members of our software up here on this page and you just want reiteration, that's exactly it. Repeat these things in your head over and over. That's what I do. I literally read the same things over and over again in a slightly different way by different authors to repeat in my head. But this is the stock market to GDP ratio that I created based on the S&P 500 going back to 1929. It's the S&P 500 equivalent before 1957, because I think the S&P 500 started then. So in history, the historical ratio was 0.929. We're currently at 1.56, which is 68% overvalued. The market's currently at 4,002, and it says fair value is 2384. But here's the key why I'm showing you this. It's been overpriced in red since 2013, and fair value back then was 1545. So in that time frame, even though the market was overpriced, the fundamentals got better and better and better and better and better. So it drove up the base value, the fair value for the S&P, right? Yep. However, look at 2000. The peak of 2000, the ratio is 1.46. We're currently at 1.56 with the market, with the NASDAQ down like 30% this year and the S&P down 15%. We still have a long way to go. But in the future, as prices go down on really good companies that I can understand, not Peloton. I don't understand Peloton at all, how it's going to, I couldn't tell you if it's worth $1 or $200 a share. I will tell you this, the market it was worth $200 a share because it fell from 180 down to 9. Carvana. Yeah. I think Carvana might be a value play based on sales ratios, but I don't know. I want to stick to companies I can understand very well and that I can determine with reasonable accuracy. When I say reasonable accuracy, my reasonable accuracy is this. You've heard me say this before if you've watched our channel. 1, do I think the company will be around 10 years from now versus today? Every single company on my 20 stocks I want to own I will be surprised. I literally be surprised if even one of them is not around 10 years from now. In the sense of like, hasn't been bought out, but probably has gone under. 2, will it make more revenue and profit 10 years from now than today? And third one, if the answer to that second question is yes, and the first question is yes, can I pay a reasonable price for that? And most people stop right at question 2. But the most important one is, can I pay a reasonable price for that investment today? That's why value investing works. Because in the long run, stocks are a weighing machine. In the short run, a voting machine. That means in the short run, if they're really popular, they're going to go up. If they're not popular, they're going to go down. But in the long run, the fundamentals, the cash flow, the balance sheet, the income, the revenue, those are the things that matter in the long run. If you had a business, if you owned a business, and some of you might own a business, and it makes $100,000 a year today. If 10 years from now, the business makes $1 million a year, your business is probably worth 10 times more than this today, assuming you pay a reasonable multiple of profit today. Right. If you pay 30 times profit for it, newsflash, it's probably not going to be worth 30 times more in 10 years.
Right.
But if you pay 4 or 5 times profit or whatever multiple for your industry is, you'll probably be worth $4 or $5 million in 10 years. That's the key to value investing. It's paying a reasonable price. Price is what you pay, value is what you get.
Yeah.
And we want to buy when the price is here and the value is still here. Value doesn't change much. It goes up with the company based on fundamentals, but price can oscillate big time.
Yeah, it's funny. When you see a company go up 20% in a day, do you truly think that a lot of these companies that go up 20% in a day, they are worth more at 9:30 in the morning than they were at 4 p.m. at the close?
So you look at FTX.
Yeah.
It went from 30 billion to zero 2 days later.
Right.
I don't believe FTX was worth 30 billion. I just think it was probably worth pretty close to zero 2 days before. It's just the market finally realized, oh crap, this thing is a Ponzi scheme or built on house of cards.
Right.
So guys, I've shown this chart before. With the stock market, you can apply this to any company. This is how companies' value goes up over time. But this is where the price goes. So intrinsic value goes up pretty steadily with revenue and profit. But the price Mr. Market gives you to buy or sell it will go up and down. And you have to decide, are you a seller or a buyer? That's the key here. That's what's important in value investing. This is why value investing works. Because eventually, math just proves it, companies have to sell for below their intrinsic value at some point. The emotion of the market causes that. Mo, talk about Tesla and your experience recently with Tesla.
Oh, so I have a group of friends. I'm in a group chat, and they are all hype investors. So back in COVID, when
they're not hype investors,
hype speculators.
There you go.
They were all over the Penn Gaming and the Pelotons and this and that. Recently, what's Tesla sitting at? 190. I sold puts on Tesla at $50, and they berated me saying that I was stupid and there's no way that I would be paying $50 at some point for Tesla. And I said, okay, that sounds good, but you're probably the same people when this was at 402. If I had sold puts at 193, you would have said, you're stupid. There's no way you're owning Tesla at 193.
And it's happened a lot in the last year and a half, last 2 years. February of 2021 was an amazing time for our channel. We were making videos about how ARK investment was a scam. It was stupid. And people were commenting, you're such an idiot. She has a fund. You have a YouTube channel. And her stock is down 75, 80%.
Yeah, here's ARK. This is back when Paul was talking about it. At this
Go look at our videos.
What was it, 150?
We got 160. You got 159.7.
159. And now today we're sitting at 39.
And by the way, this is why in our software, Mo, scroll up just a little bit. This is why in our software, we do the all-time high number right there.
Yep.
Because I want everybody to see what is the all-time high. You go to a company like Intel, the all-time high was like in 2000. Since then, Intel's revenue and profit have more than doubled, somewhat tripled. And yet the stock is still down from its 2000 high. Why? Because it was so overvalued back then. And the same with companies that are undervalued. Even if their profit stays the same, they can still go up in price because people misprice the undervalued portion of the company. And that happens all the time. How did Amazon in 2000 go from 113 down to 6 and then up to, the equivalent is $7.50 to 30 cents and then back up to $100 right now? There's a reason for this. It's called fundamentals. And if you pay the right price for a great company, you will make a ton of money in the long run being the market. You're not here to find the next 100 bagger, 200 bagger in the next 2 or 3 years. It won't happen.
If you're patient, you will do very well in the long run, but you have to be patient.
And that's why emotion and mindset is the hardest part of investing.
Don't listen to your friends. Don't listen to the media. Just stick to what you know and trust your own process.
And this is why we have our community. I created this community specifically so that thousands and thousands of like-minded people could talk every day. The number of conversations I see in there in which people say, remember what we're doing here. They say process. It takes time. And it's amazing to me that I'll see people say, this is awesome. Meta and Baba are down again. I'm going to buy more. Now, are we right or wrong? I don't know. But if you give me 20 or 30 companies that match these fundamentals as Meta and Baba, you are going to do very, very well in the long run. Look at a guy like Monish. A year ago, we had an interview with Monish Prabrai. He loved Micron at $90 a share. What's it at right now? 50 some?
$60, I think.
And guess what? I like Micron, but at much lower prices than Monish. But he's a phenomenal investor. I don't know what he saw in it versus me, but that doesn't matter. What matters is the process. And the process, if you mix it with the right emotion, the right mindset that we have here, you're going to do very well. All the tools we have here are great, don't get me wrong. But these are best used when you have the right mindset and process. Just like marriage. If you go into marriage and a relationship with the wrong mindset and emotion, doesn't matter who you're partnered with. Doesn't matter. You're going to screw it up. It does not matter who you're partnered with. You could be partnered with your perfect person, but if you don't have the right mindset, it's over. It's absolutely going to be over and not going to go very far. So guys, subscribe to the channel. If you're interested in the software, everythingmoney.com, but we have a lot of these videos, over 1,900 we've done, repeating mindset and emotion. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?